Welcome to the InterMarket Analysis Update. This is a video that I do every week where we look outside of just the S&P 500 to see if we can get any insight, any clues, anything that's happening in other markets. And there's a number of different areas that I go through. This is being prepared for Monday, June 23rd. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. The first area is just valuation. I look historically and then we look forward to see if we can get some insight that way. We look at growth versus value, and kind of interesting, the growth chart all by itself actually crossed over positive this past week, where value is still in a downtrend. And we take a look at inflation. We try to keep an eye on that, and that's been creeping back in because of the geopolitical things that are happening. That's really pushing oil up. We've got gold that's been holding at higher levels, and the inflation expectations are starting to pick up a little bit. So we want to be aware of that one. Then we look at other markets like oil, like gold, like aluminum, corn, oil, and then some different studies that we look at within inside of oil. But these are not markets that we follow day in and day out. I keep an eye on the bond market. We do look at oil, we look at gold. I don't talk about gold every day, but we just want to keep an eye on these things. Then we look at the 11 sectors that make up the S&P 500, first individually, the sector all by itself, and then we compare it on a ratio basis with the S&P 500. Then we look at some different indexes, then some different correlations, stocks to bonds, stocks to oil, interest rates to oil, a lot of different things there, and some very long-term trends. And then finally, at the very end, we go through a list of those things that are positive and those things that are negative. First area is valuation. This is looking back, and we use a PE ratio of 10, 15, or 20. If it's green down here, that's considered to be inexpensive or cheap. If it's under 10, then it gets even more inexpensive or cheaper. That way, when we get up near the blue line, that is when something is considered to be fairly priced, and then the red line and above is when we're expensive. And we're well above that. And as I keep pointing out, we've been above this line for years now, but that doesn't seem to matter. So, and you can see, going back all the way to 1990 on this chart, how we spend a lot of time above the line. And eventually, yeah, sometimes we come back down, but that's more due to market forces and economic forces and different things that are happening. So we've been this way. So we don't use this as a timing mechanism just for information. Down below is the difference between the current price of the S&P and the PE ratio of 20. And also, as I keep pointing out here, we would have to fall all the way down to 4,200. We're just under 6,000 now. We're in the 5,900s to be considered just expensive. So, but that's gone on for a long time. This also looks at different valuations, going back to 1980, different events that have happened along the way. You can see here, the red dashed line spends a lot of time above this. Now, we had just become totally crazy here, and this is the dot-com boom and bust. Then we were getting better, and even when we started to go down into the great financial crisis, we were still not considered to be expensive at that point. But then coming up out of the financial crisis and then the big moves up that we've seen, we barely came back down below the red dash line even during the COVID crash. And then going back up, and we've been above it ever since. Then Robert Schiller has a variation of the PE ratio where he takes a smoothed approach, a 10-year average of earnings, instead of the quarterly earnings that we use to look at the PE ratios here. And with his calculation, we're at 36.35. You can see we're pretty high up on the chart. The median and the mean are still between 16 and 17, and we're coming in at 36. So we're more than double being expensive according to Robert Schiller's approach. But the market looks forward. And we have this purple line, which are the Mega Cap 8, the Magnificent 7, the Illustrious 11, whatever you want to call them. And they're coming in at 27.6. We also use that 10, 15, 20 scale with this chart as well. So we're very overvalued, but we've been very overvalued before. So again, you don't want to use this as a timing mechanism. Even with the S&P, we're above 20. We're at 21.2 here, so we're considered expensive. Now, more fairly priced are the two areas that have really lagged, mid caps and small caps. With the mid caps coming in at 15.5, right around that midpoint fair price area, and then the small caps, which are actually under 15 at 14.7. So again, this is just for information, not used to really make any decisions. And this is another way we can look at this. I get these charts periodically. This looks at the PE ratio. When this chart was put together, we were at 22 with the S&P, and there are different sectors of the S&P that are actually above this 22 level. Industrials, discretionary, even though they've been really suffering, and tech. And these are growth areas. So a lot of times when the market's more positive, they will actually be more expensive than the S&P itself. Then we have other sectors that are underneath that with energy at the bottom. Now, this is probably changing a little bit right now because of the geopolitical things going on. We're seeing the energy sector seeing a little bit of life. Then this is another chart I ran across this week. It says after trending in the same direction from 1870 to 1990, so there's a little bit of history here, the average US PE multiple, they call that a multiple, the red line has drifted 40% higher from 1990 from 14. So maybe we need to adjust these points to 19.5. That means that the current PE of 23.5 is only 16.7 if adjusted. Okay, is that reasonable? So maybe this 10, 15, 20 scale is a bit antiquated because it's not really that useful. And we look at it every week here, and I just continue to say we're overvalued. Okay, but the market goes up, down. It doesn't really adjust based on these valuations. So maybe we need a little bit more of a dynamic approach because the 10, 15, 20 scale is static. This way of measuring this actually moves a little bit more when you take historical context into account. Okay, then growth. Here, finally, we're seeing a golden cross here when we look at the growth index all by itself, where value is still in a downtrend. Now it's improving, but it's been underperforming. It's been going up here, but if we go back to the growth chart, you can see it really came up out of those April lows. Now, lately, we've been chopping sideways, and that's why we're not trending. But neither one of these are really falling apart, but the growth one is outperforming. And we see that here. Now, we pulled back over the last day or so, but when we do a ratio between growth to value, when this is going up, that means growth is outperforming. Here's an inverted version of that same chart showing how value is underperforming growth. And I look at this in a number of different ways. First, we look at some ETFs and a longer term chart. Growth is outperforming here. This value is underperforming growth. And we look at some indexes. Growth is still outperforming value, so we're getting confirmation there. This shows how value is underperforming growth. And we look at a growth versus value ETF, and the growth is holding up quite well. This is showing how value is underperforming growth. And we break it out into different indexes. The small caps, even though they've been just really frustrating and pretty much going sideways, the growth to value ratio has been holding up. And the same thing, sideways with the mid cap index, but the growth to value ratio has been doing okay. This is the one that we do pay attention to, and we just have seen a recent golden cross with the growth to value ratio for the S&P, but ever since about middle of May or so, we've been just chopping along sideways here. Then we want to keep an eye on inflation. And the CRB index, this is a monthly chart, so it isn't completed yet, but we're going above the moving average. That's a little bit of a concern, but this could be more short-term geopolitical, where the market gets out of whack and then it'll eventually work back to more of a normalized type of approach. We're also seeing a real pickup here with the inflation to deflation ratio. We've actually crossed for the first time in quite a while, in a few years, we're actually crossing above the moving average. Now, the moving average is still declining, but this chart won't complete until the end of June. CRB index in an uptrend and going up mainly because of oil. And gold has been doing well also. The Baltic Dry Index, another measure of inflation, really started to spike up here. Now it's pulling back, but it's really going above both of its moving averages. These are the inflation expectations, which had been dropping off since the beginning of 2025. Now they've been starting to go back up, and they did spike up here a little bit, but we're not really breaking out at this point from the previous high. And then we look at inflation expectations, the previous chart with tips, Treasury inflation protected securities. This ratio is still going down for right now. It means that tips are actually outperforming. So this isn't causing a lot of problems at this point. Then we do keep an eye on aluminum, which is still in a downtrend, and corn in a downtrend and pulling back. Actually, it's in an uptrend, but it's pulling back. Wheat continues to be in a downtrend. Fertilizer, it was going up there for a while. Now it's been pulling back recently. And lumber is in an uptrend, but kind of a loose uptrend. And then here's oil, where we were in the high 50s there for a while. Then we spent a lot of time in the 60s. Now we're getting up into the mid 70s. We closed at 74 on Friday. And then the gold to oil ratio, since when gold was going up, oil was going down. And so we saw this ratio going up. Now we're seeing this ratio coming back down. And we look at the 10-year yield, which is the black line here, and the red dashed line, which is oil. And we're seeing that they're going in the opposite directions as oil has really been going up lately. Heating oil, it really spiked back up, but it's still in an overall downtrend. And gas, you're probably feeling this at the pump already. We're still in a loose downtrend here, but we really went up just this past week. Natural gas is in an uptrend. And then diesel, a lot of the military equipment, they might be stockpiling diesel, so the price is going up. You can see the red line and the blue line. After it had been declining, now they're starting to spike back up. And copper, which is in an uptrend, and as I always say, that bodes well for the economy going forward. And the copper to gold ratio, just chopping along sideways ever since about April, where when this is going down, that means the gold was outperforming and copper was underperforming. Lately, they've been just chopping along with this ratio. So here's a longer term look at the copper to gold ratio, where it's been going down and then chopping sideways. And then to give it a little bit more context, the red line is the 10-year yield and the green line is the 2-year yield. We've been coming down with the 2-year yield, where we've just been chopping along here, usually above 4% recently with the 10-year yield, as the copper to gold ratio has been going down, which is different than what we were seeing before. They tend to move in the same basic direction. There's been a decoupling pretty much since the COVID crash, as the economy is possibly changing characteristics. And then here's gold, which, I mean, it has good up days and then it goes down for a while, but it's really not doing all that much lately. Then silver looked like it was breaking out, and then you have some folks taking some profits, so it's been falling back. And then we look at a gold to silver ratio on top. When this is going up, that means gold is outperforming. Lately, silver's been outperforming, so this ratio has been going down. And then we plot the US dollar index down below and then do a ratio between the top, a correlation between the top chart and the middle chart. And there's a pretty strong correlation. The dollar's been going down and this ratio has been going down as well. Here is the dollar, which is in a downtrend and well under 100 now, in the 98 range. And the US dollar index has been going down, so the euro's been going up. And then we have the Japanese yen, which it's longer term, it's in a downtrend, but lately it's been coming back up against the dollar as the euro's been going up. The dollar's been going down. And here is the euro against the dollar in a pretty solid uptrend. The Japanese yen, it's in an uptrend, but not quite as solid. It's been going sideways lately. And the British pound is in a pretty solid uptrend compared to the US dollar. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Then we switch over and look at some indexes, and I have been pointing this out in the last few daily videos. We're seeing now this could be positive or negative. What you see here is the bar chart. That's the S&P 500 that everybody knows, and it's a weighted index. So Microsoft, Google, Nvidia, they have more of an impact on how the index is calculated. Well, the way of getting around that is to look at an equal weight version of the S&P, and that's the red line. You can see it's underperforming. They are on different scales, but we get a general performance idea by this. And they're kind of far apart. Now, the negative side is that we're not really seeing broad participation across the rest of the stocks in the S&P. That means that there's a few stocks that are holding it up. That could also be the positive side because these are the big mega cap stocks. And if they do well, the market does well. And so you can look at this as either half full or half empty, depending on your particular perspective. And we're seeing this ratio going down as the equal weight has been underperforming the weighted version of the S&P. And stocks had been really bouncing back when compared to commodities, but commodities, mainly oil, it's really bringing this ratio back down, but it's still in a downtrend, but it had been really improving. This is an inverted look at that same thing where commodities have been underperforming and then they were starting to outperform as stocks were going down, then pulling back. Now they're starting to go up again. The NASDAQ 100, which is growth on a ratio with the S&P 500, this is more positive when the NASDAQ 100 is outperforming. And the S&P 100, even though it's pulling back to the 50-day moving average with this ratio, it's the bigger stocks that make up the S&P are outperforming. The NASDAQ 100 kind of dropping back a little bit. Noticed this about a week ago when the NASDAQ 100 is really outperforming the NASDAQ. Now, they both can be doing well. And earlier on, this was actually going up when stocks were going down. This kind of helped us understand that, okay, maybe we're going to hit some kind of a bottom because the bigger stocks are holding up better on the way down. Now, they were going down with everything else, but on a ratio basis, with the NASDAQ itself, the NASDAQ 100 was outperforming. And then as we've been coming up, we've been seeing this coming down as a ratio. Now, this could also be taken as positive. When this ratio is going down, that means the NASDAQ is actually holding up better than the NASDAQ 100. And that could be suggesting more broad participation. Then the NASDAQ is outperforming the S&P. They both can be doing well, but we're also actually getting to a golden cross here with this ratio. The mega caps pulling back a little bit recently, but they are outperforming the equal weight version. And that just also confirms that it's the bigger stocks that are still keeping things together. Mega cap growth in an uptrend. We're starting to see a golden cross. We're not quite there yet, but we're above both of the moving averages. The robotics and AI ETF just kind of chopping along sideways inside the rainbow. And still, this particular ETF is actually underperforming the tech sector. When we look at semis to tech, we want this ratio to go up when we're more positive. It was doing that, but lately it's been just kind of pulling back as the market really hasn't been going anywhere. And then we look at small caps to the S&P. Small caps continue to underperform. This is that same ratio here in red, where the red's been going down as the blue's been going up, which is the S&P. And small caps continue to underperform the tech sector. Low volatility stocks pretty much chopping sideways, coming down to their 200-day moving average. Now, the 200-day moving average was still going up. As this has been going sideways, they're starting to meet up with each other. But when you do a ratio of low volatility stocks with the S&P, still underperforming, and that's more positive for the S&P. Then the Dow Jones Composite Average, which is the Dow, the transports, and the utilities together, just kind of chopping along under the 200-day moving average with this particular index. Energy sector starting to bounce back up. This is when oil's going up. Now, tech has been holding up okay lately, but energy is going up so much that this ratio is going up. But longer term, it's really been coming down, and we are in a downtrend. And growth stocks compared to bonds, still holding up quite well, and that's what you want in a more positive environment. The tech sector is really bouncing back when compared to the 10-year yield, even though this is still in a downtrend. And then this is that same thing inverted, where the 10-year treasury yield was actually outperforming the tech sector. Now it's starting to pull back. Discretionary, this has been a disappointing area. When we do a ratio between discretionary and staples, we're just kind of humming along right at the 200-day moving average. Not really seeing a big breakdown. So support is holding, but we're not really seeing a breakout either. And then staples have been underperforming discretionary, even though they're still in a longer term uptrend. And gold was really outperforming stocks, but lately this has become rather choppy. Stocks haven't been trending, and gold has been just going sideways as well. And then gold to the dollar's been going down. So even if gold goes sideways, this ratio still goes up. And then we take out US stocks and then we look at stocks in the rest of the world. They're still doing quite well. They've been pulling back lately, but they're in a more solid uptrend. Where they're underperforming is when we put US stocks back into the equation. We're actually still in a downtrend here. Then we look at the advanced decline lines, and I go over this in every daily video. The takeaway from this is we're still above the moving averages, except for the small caps are coming back down to their moving average. Then this is traditional Dow theory. The Dow's been really having a hard time staying above its 200-day moving average. The transports have been going sideways. Utilities have been going sideways as well, but they've had more of an upward move for the most part. But this also confirms what we're seeing in the S&P, where we're just not trending. And not seeing a big change here with the Dow to transports ratio. And this is going up, the Dow's outperforming. It's been rather choppy lately. And then the transports, they've been going sideways. And then we look at the transports to S&P ratio. When this is going down, that means the transports are underperforming. But we do a correlation, and that's still holding up. That's still in the red area. Then we look at a different take on Dow theory, where instead of using the Dow, we use the S&P. Instead of using the transports, we use the NASDAQ. Not really seeing anything that divergent, either positive or negative right now. They've been pretty much in lockstep. Then we break that down a little bit further. Instead of using the S&P, we use the equal weight version. Now, that did not set a new all-time high. This could be taken as a negative divergence, where we set the high back in 2024. We did set an all-time high in February with the S&P itself, but not with this index. So that's a bit of a negative divergence, a lower high here. Then we broke down and we're trying to come back up, and we really haven't broken out of this previous range that we were in. Then we look down, instead of using the NASDAQ, we use an equal weighted version of the QQQs. It's been performing well, but not coming back and setting an all-time high, at least yet. The FANG index, though, it's in an uptrend, and it was really helping the market come up out of this, but now it's started to go sideways lately as well. The Wilshire going sideways, still above its 200-day moving average, as is the total U.S. stock ETF. ARK actually generating a golden cross here. Man, it was up. It was up over 8% for the week. So it kind of got a bit of fire underneath it. All stocks, which looks at U.S. and international stocks, in an uptrend here. And it's mainly international stocks that have been helping this index stay together. High leverage loans still holding up, not even back down to their 50-day moving average. And this is another economic gauge that we can look at. And so this is still looking pretty positive for the time being. The NYC composite, another area that's held up relatively well, still above both moving averages. The micro caps, these are the smaller stocks. They're still in a downtrend, but they're coming back down to their 200-day moving average. Emerging markets, when you look at them by themselves, they are in an uptrend. Japanese Nikkei, sideways. Just can't seem to break out. Bitcoin is in an uptrend as well. Semiconductors, still in a downtrend, but above both of the moving averages and really improving here. And this is a big part of the market trying to improve if semiconductors really start performing well and stay doing well. Here's another look at that same ETF where we're above the rainbow. And then we look at the S&P on top and the home builders in the middle, and then the correlation between the two is really pretty strong. Home builders have been really weak, and this started to break down at the end of 2024. And I watched that chart pretty closely, and I was just bringing it to your attention. But then we saw things kind of fall apart after that with the S&P. So we just keep an eye on these things. Now, when we look at long-term trends in the world, China is pretty much going sideways, where emerging markets are now going down, as are European markets, Japanese markets, and US markets, according to the KST momentum oscillator. Then we do another ratio of the S&P 500 to stocks in Europe, Australia, Asia, and the Far East. We drop down, and the momentum is still negative on the bottom. This is a monthly chart, but we came back above the moving average, so we are improving. And we look at bonds based on price, still above their 50-day moving average. The total bond ETF is in an uptrend. The stock to bond ratio is above the moving average. This is a monthly chart. Bonds are underperforming stocks when this ratio is going down. The Pring World Bond Index is in an uptrend, but kind of just chopping around right now. Junk bonds doing quite well in an uptrend, and the uptrend is actually looking pretty solid. Then we look at investment grade bonds. These are more conservative bonds. They've been kind of chopping sideways, and they're still technically in a downtrend. And then the corporate bonds are in a downtrend as well, even though price is above both moving averages. The stock to bond correlation is neutral right now. The 10-year yield, the takeaway from this is we've established a higher range than what we have seen over the last 40 years. Then riskier bonds like junk bonds, and then do a ratio with more conservative bonds, still hanging out at the lower end of the rainbow. Junk bonds, but I went through that. Junk bonds are doing quite well, and they're actually outperforming government bonds here. People are, as I say this every time, people are willing to assume the risk to get a better yield. And here's a daily chart of the various yields across different maturities, where we've generally been dropping down a little bit. Interest rates had been going up there, and we're watching that 4.5% level with the 10-year yield. Then a weekly chart of international yields here, where we've been coming down a bit with US and UK rates, German rates, and then Japanese rates. And we look at the volatility of bonds. That's the MOVE index on top, the volatility of stocks in the middle. The correlation is still pretty high between the two. Then we look at some ratios between stocks and short-term bonds, still hanging out above the rainbow. Another broad market measure with 3 to 7-year bonds, still above the rainbow. The tech sector to 3 to 7-year bonds, still above the rainbow. So we're not seeing any real worries, at least yet. And then another broad market measure, the S&P 1500 with short-term bonds, still above the rainbow. And then we look at the 30-year price of bonds, and this continues to be in a downtrend here, even though it's been bouncing back up a little bit. And then we do a ratio between the long-term bond and commodities, where the KST now has this going into a downtrend that started early in 2025. Here's where we look at the different sectors. First, we look at the materials. They were coming back up. They hit their 200-day moving average and have now been going back down. And they're underperforming when we compare it to the S&P. Communication, a growth area, in an uptrend above both moving averages and holding up, even though they're going sideways when we do a ratio with the S&P. This is one of the areas that we need to hold together. And back when the market's more positive, we see communication outperforming the S&P. Energy really coming back up lately due to these geopolitical things going on. And even though it's still in a downtrend, you can see the ratio has really bounced back up as oil has been going up compared to the S&P. Financials still looking positive here. And I've been pointing this out in the daily videos as well. We do a ratio of the financial sector to the S&P. We came all the way down to the 200-day moving average with this ratio, and so far we're bouncing up off of that. We'll see if that can continue. Industrials just seeing a recent golden cross here. They've been holding up better than a lot of other areas. And when we compare it to the S&P, this has been one of the stronger areas as well. The tech sector, which is showing a lot of improvement, and we're just about getting ready to see a golden cross with the tech to S&P ratio. Real estate just really struggling along its 200-day moving average. It's also in a downtrend and really underperforming and going sideways with this ratio when compared to the S&P. Staples been pretty much going sideways, coming down to their 200-day moving average, but really underperforming when we compare it to the S&P. And staples are more defensive, and if we're more positive on the market, we want this ratio to go down. Then healthcare, which has really been struggling, in a downtrend below both its 200-day and 50-day moving averages, and just kind of chopping along sideways for the last month and a half or so when we compare it to the S&P. Utilities still have this basic upward move here and are still in an uptrend. And in an uptrend when we compare it to the S&P, but really falling back down to their 200-day moving average with the ratio. Then we keep an eye on the S&P to utilities ratio. When this is going up, that means the S&P is outperforming. It was improving, but now it's just kind of stalled out over the last week or two as we've not been trending. Discretionary, this has been more disappointing. We are still in a downtrend here, but we're above the 200-day moving average and just kind of drifting sideways. And if anything, we're kind of drifting lower. And then when we compare it to the S&P, just not really helping things. This is an area that we really need to do better for the S&P to do better. Then the semis to tech ratio, this has been improving, but it's kind of stalled out recently. We look at the S&P to the 10-year treasury yield in a downtrend, but stocks have been improving. Semiconductors, this is another area, huge part of growth, improving above both moving averages. The Dow Jones Semiconductor Index getting kind of close again to a golden cross. And then this is a weekly chart of the SOX index, which are semiconductors, and a 200-week moving average. Still looking good that way. And then we do a bond to stock ratio, and this is going down. That means bonds are underperforming, or to say it another way, stocks are outperforming, and that's more positive. And we are seeing a general improvement with the semiconductors to Dow ratio. We haven't really come back yet, but we're finally looking like we're breaking out of these lower highs. We're trying to show some improvement with this overall ratio. Then we look at an intermarket analysis chart. Even though it's been going sideways, gold is still the best performing asset in 2025. Now oil is in second place. My gosh, at the beginning of May, it was the worst performing asset. So these are all the geopolitical things that are taking place. Then we have commodities in purple, stocks are in black, commodities are in bonds based on price are blue, and then the dollar is the worst performing asset in 2025. Correlations, S&P to oil, they're kind of neutral right now, where the S&P has been not trending and kind of going sideways. Now this has oil. Oh, I'm sorry. This is the dollar index. No wonder. Yeah, this is more neutral. Here's the S&P to oil correlation. Now they're starting to go in opposite directions. Oil's really been going up as stocks have been going sideways. And then tech to the 10-year yield, also having a tendency to go in opposite directions. Stocks to the 10-year yield, pretty much neutral right now, slight tendency to go in the same direction. And then stocks to the 2-year yield, dropping back down and getting inside of that neutral area. Then some long-term charts. This is a monthly chart of the NYSE, and this is still above an advancing moving average. So that's still holding up for right now. But the momentum, the copy curve, is now, since the beginning of 2025, it's actually been declining. Another monthly chart of the NYSE, and then the NYSE record high percent index. This was really coming down as stocks were under pressure. It's trying to bounce back up, but it declined just a little bit in the latest reading. And then a monthly chart of the S&P, still above an advancing moving average. Still negative, but trying to turn back up with the PPO, another momentum oscillator. And then the S&P on top, still above the moving average. And then we do a stock to commodity ratio. And this is showing how stocks since the beginning of 2025 have been underperforming commodities. And then another stocks to global index, still down, kind of hanging out a little bit below the moving average. The momentum continues to be down. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then at the very end, we list all the things that are positive. And for the first time in quite a while, growth is now back on the positive side. Copper is also in an uptrend. And then the euro, British pound, and yen when compared to the dollar. The CRB index, gold and silver are in uptrends. The low volatility ETF, even though it's going sideways, It's hanging on to an uptrend. Staples are in an uptrend. And then total bonds, high yield bonds, investment grade bonds, junk bonds, and the World Bond Index. These are all based on price, not yield. They are in uptrends. The FANG Index is in an uptrend, as are high leverage loans. We like that for the economy. Emerging markets are in an uptrend, and Bitcoin is in an uptrend. Then the negative side is we still see value in an overall downtrend, and the mega caps are improving, but not quite there yet. And the dollar is clearly in a downtrend right now. Corporate bonds are in a downtrend, the Dow Jones Composite. The tech sector improving, but not quite positive yet. Semiconductors improving, the SOX index, the indexes and the ETFs that we follow, they're looking better, but they're not quite breaking out yet. And then we look at the Dow, the NASDAQ 100, the NASDAQ mid caps, small caps, and micro caps. And this also includes the S&P. They're all still in downtrends, even though most of these, except the mid caps, small caps, and micro caps, the bigger indexes are above both of the moving averages. It just takes some time for this to cross over and look more positive. The NYSE composite, one of the better indexes for holding up, especially when we were going down back in March and April. The Wilshire 5000 and total US stock ETF, they're above both moving averages. They are improving, but they're not quite there. ARC, this could probably put back over on the positive side. That's kind of a surprise. I'm so used to ARC underperforming, but it's actually now improving quite a bit. And then all stocks, which are US and international stocks. Thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.